Well, good morning, folks. Hope everybody's doing well. If you could help me out here, I'm looking for some feedback on Twitter. If the audio is okay and if you can see my NASDAQ 1 hour chart clearly, just give me a 5x5 and I'll start. Thank you, Dominic. All right, you, thank you. All right, so we had FOMC yesterday, obviously. Let me get in here and get to my chart where I can change everything. So I'm going to delete everything. We're going to go back to a clean chart, weekly. All right, so I want you to see that obviously we have moved lower from this swing high on August 28th, 2023, that week of. Now we have the low right there for the week of August 14th, 2023. If you look to the left of that, you'll see my quarterly shift objective, which in my mind, I feel like we're about to see some softness on equities. So a lot of things going on in the world, and I think also in the coming weeks, we're going to see some events that maybe might be shocking to you, and that's going to cause some reverberations in the marketplace. And if you've been listening to my Twitter spaces, you know exactly what I'm talking about. But we're not going to talk about that here. OCD's flaring, that's not the same color. All right, then we have a small little volume imbalance in here. You can add that to your own chart here. But whenever I have this, where I have like a imbalance, which is this candle right here. Okay, so the candle on the weekly chart for May 22 or 22nd, 2023, that is a buy side imbalance, sell side inefficiency. Okay, it's a fair value gap, but the specific is a BISI because it's an up close candle, so it's buy side imbalance. It's requiring a repricing with sell side, it means delivery on the downside. So buy side imbalance, sell side inefficient. When I have this, I just simply take the whole range and I highlight like that. That's why sometimes in the old videos, before I actually started talking about the details about the things I was looking for, students would ask me either on baby pips back in the day or shortly thereafter once I left them. And no, they didn't kick me off of the forum, and they would love for me to come back there, and I would never do it. But the idea is this imbalance right here, right in there. I'm including that. So it's not just a matter of having it just like this. It's having the entire range. Okay, so we want to have that highlighted. So we do have sell side below the low of the week of Monday, August 14th, 2023. And that is, in my opinion, I think we're going to try to gravitate towards that maybe even before Friday's close. But next week and going forward, I want to see us draw down into this area here. Now, how much of an animation to the downside do we get once we get into this area? I have to see that based on how we trade to this area. Okay, so don't think I'm calling for one shot, one candle right there, which it can do, but I'm not putting myself out there saying that. Over the coming weeks, I'm willing to submit to the idea that we're going to draw down into this little area here, which is specifically aimed around that buy side imbalance, sell side inefficiency. Now, before I go any further with NASDAQ, I want to drop into S&P. Same thing, we're going to clear everything. And this buy side imbalance, sell side inefficiency for S&P. This is a weekly chart, so the week of May 30th, 2023, it has a volume imbalance as well. Notice that. So the volume imbalance is the separation between the bodies of two consecutive candles side by side. So if there's ever a separation between the actual bodies, even if there is a wick that connects the two bodies, that's a volume imbalance. Okay, that's mine. It's not in your books, but people are writing about it on Amazon. Man, I just went through Amazon last night, by the way, and there are so many books written about me, my concepts and stuff. It's kind of weird, actually. I went to bed thinking about that last night. It's strange. But buy side imbalance, sell side inefficiency, and the volume imbalance, that's what's being highlighted here. We have sell side, which is easily going to be engaged here probably this morning. And do we accelerate down into this area here? Okay. One of the things I'm considering and what I'm looking for is the amount of speed. The amount of speed of how fast they want to get down into this area here. Because if they're really trying to get down there quick, to me, I see that as we're probably going to go down for a longer bit. And we may end up going down to levels like this here by the time we get to January or March in that time window. That's about as far out as I can see it. I really think there's a lot of things coming on the horizon that are going to be plaguing the financial institutions, equities, currencies, commodities. We're getting ready to go into some really heavy stuff. And a lot of folks that have risk right now are not going to want to have risk. So they're going to accelerate that and amplify, I believe. And I'm kind of like co-signing it right here so we know what I'm doing here. My perspective going forward over the next 6 months or so is bleak. It's not good. So you have to be very, very careful. Okay. And we're going to drop into the dollar index real quick. Buy side is here. We're drawing up into that. It's taking a long time to get there. But eventually, I think that we could have some kind of a blow off where if we get above this high here on the week of March 6th, 2023, if we get above that and start to accelerate, go back over to the left here, and you see that November 7th, 2022, that big sell side imbalance, buy side inefficiency. We might want to revisit that after taking the buy side above the high of November 21st, 2022. So longer term, we might see it try to gravitate to that. How and if we trade that high will be indicative of whether or not I think we go to the 115s. If everything happens like I'm expecting it to happen, and it kind of like increases in its pace, the dollar index could actually go to like 120, 122 because of the flight to quality, safe haven. They're going to want to try to promote the idea of, come in here, put the money into the dollar. Eventually, the rug's going to get pulled from underneath it. But that's kind of like what I'm anticipating. Not that I have to have that every single day behind every trade I'm taking. That's not what I'm showing you here. Obviously, we're on a really, really high time frame weekly chart. And for someone that's brand new to trading or someone that's brand new to my analysis concepts, it might sound like, well, this means dollar goes straight up every day, all day long, every candle, every 1 minute candle, every 1 second candle is going to be an up close candle. ICT is bullish on dollar, so I can't lose by going short on all other foreign currencies at any given time. That's not what I'm stating here, but many times that the new trader or the new student that comes to me will add their own interpretation. So I have to take a long way around the barn, if you will, to explain myself, which makes me sound wordy. Okay, and I have a lot to say about something that in my mind is paramount to protect the new student, the new viewer, that may take the information I'm sharing and do something reckless with it because they're impulsive or inexperienced. Okay, so just know that from a longer term perspective, these are some of the scenarios I'm considering. I don't require them to be this way. I mean, obviously, I can spin on a dime and trade, intraday on very, very, very small time frames and not have a bias. You don't need a bias. It just means that while you're learning, it's advantageous for you as a student, or if you're going to be speculating or learn how to trade, it's very advantageous for you to want to go in with the expectation of determining a directional bias, only looking for setups in that direction. And if you can argue the case that if you see something that you think is going to start going up, regardless of what market it is, I don't care if it's even crypto. I don't trade crypto. I have students that make money in crypto and swear by my concepts. I have never traded crypto, and I don't do synthetic indices. I don't even know what the hell that is, but I get questioned a lot. What should we do when we first start looking at your content? Take your time, go through at your own pace. But the number one goal is for you to determine how to find the next draw on liquidity. That means where's the market likely to gravitate to? Well, I start every student on this time frame on the weekly chart, because even if you're wrong on an intraday basis, okay, say you're looking for a session, say from 7 o'clock in the morning to 9 o'clock in the morning, and you're trading Forex, or you're trading indices before the AM session begins. If the weekly chart is indicating that it's likely to move higher, and you're only filtering out setups that are likely to create bullish scenarios, that means the market trades down to a buy side imbalance, sell side inefficiency, or it trades down below a short-term low, and it creates an SMT divergence where a closely correlated instrument, like for instance, say you trade euro dollar or pound dollar or Australian dollar and New Zealand dollar, those two go together like euro dollar and pound dollar. They're very, very closely correlated. If you're looking for things that would be bullish, you only need a few things, not everything that I teach. Don't think that you have to have all the things I've ever taught in your model. You don't. Like, you don't need to do that. You only need a few things. You need something to give you a premise on a bias based on a higher time frame. And the weekly chart is where I put your attention to first. So if we're thinking along the lines that 105, let's see what the candle high is here. If you think that the dollar index, and you agree with what I'm saying here, and I'm not saying you should. You shouldn't. If you're brand new, don't trust what I'm saying. Wait and see if it happens. Because I'm not 100%. Sometimes it doesn't happen for me right when I'm looking for it, and I have to either sit on my hands or reverse, or I'll take a loss. But that high comes in at 105.883. So if you think that the market is likely to keep drawing up to that level and higher, it's reasonable to anticipate weakness or sell setups in the euro dollar, pound dollar, Australian dollar, Kiwi dollar, all other foreign currencies that are paired with the dollar as a secondary in its name. Anything that has the dollar first in its pair name would be going higher. So if you're thinking about looking at the market like that, and if you want to subscribe to that idea, whenever you're looking for setups, whether it be intraday, whether it be on a daily candle and you are a position trader and you don't have the ability to get into the lower time frames because maybe you're running a business, maybe you're still a student, you're in school, you're in university, or you just can't be in front of the charts because you have to sleep and your family dynamic doesn't permit you to be able to do intraday trading, you can trade with the opening price. All you have to do is find out what the opening price is. Okay, there's two of them that you can use. One is the opening session in Asia, that opening price. You want to see it trade lower first, ideally, below it. And then when it moves higher, above the opening price, you could be a buyer of strength and use a reasonable stop. You will have to babysit it a little bit, but once you have that position on, you just let it go. You don't micromanage it. You don't get scared about every little fluctuation. You don't even look at a lower time frame, and you just let it go. You will not get a lot of trade setups. You will get stopped out. But the wins that you have are a lot longer in duration, and they'll make up for the small little single paper cuts that you get along the way. So there's not a matter of a necessity for you to trade in lower time frames. It just means that I like it because as a teacher, it gives me lots of opportunity to teach something that repeats over and over and over again. And the elements of precision, because these markets are algorithmic, it's not random. You can apply that same logic to higher time frame charts, like a weekly, a monthly, a quarterly chart. You can change this thing to whatever time frame you want. There's going to be inefficiencies, and that's one of the exercises and homework assignments I want you to do for this weekend. Look outside the normal time frames. When we go through things like the monthly, the weekly, the daily, the 4-hour, the hourly, 15-minute, 5-minute, and now 1 minute. It's been popularized by me. So they're like the main staples. And I used them simply because most of the people that were coming to me as a would-be student, they're familiar with that time frame. It's not too jarring to ask them to look at things like a 14-minute chart or a 12-minute chart or a 35-second chart. You have to start manipulating the time frames a little bit, and you'll see things that aren't necessarily in what everybody else is looking at. Because as the market goes higher, and again with the premise here that we think that the dollar's going to move higher, back into the lower time frames, and say you're focusing on 7 o'clock in the morning New York local time to 9 o'clock in the morning, and those are your operating hours. You have a 2-hour workday, and you're bullish because the weekly chart suggests that the dollar's going to go higher. That means you're going to be bearish on euro dollar. You're going to be bearish on pound dollar. You're going to be bearish on every other currency that has the dollar as the second in its name. We do not trade the dollar index. I don't trade the dollar index. I've never traded the dollar index. It's too thin. But we use it as a barometer. So if we're bullish on dollar, that means it's what? Is that a risk on or risk off scenario? Risk off. That means all other assets are likely to do what? Have very, 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 very difficult time moving higher. It can on a very short-term basis, but eventually it will bend the knee and move lower. Dollar up, everything else bends the knee lower. Dollar down, it allows what? Risk on. Risk on allows for the commercials, the large entities that come in the industry and buy up big portions of like commodities. It gives us the freedom to trust and confidence to trust that rallies in equities and rallies in foreign currencies are trustworthy. And too little is done in this area for new traders because they just want to go in and find some kind of pattern, some kind of indicator telling them to do something. And I try to slow you down because while that's part of it, it's the least important thing. That least important factor of timing. Because literally, you've seen a litany of just this past month. Live real money trades, smashing it, precision, and it's no different from when I was showing you with a demo account. It's the same thing, it's the same logic. But if you have this premise in mind that you think the dollar's going to go higher, it means everything else should go lower, and you have your time window of 7 o'clock in the morning to 9 o'clock in the morning New York local time. I'm not stating that that should be your time. I'm just using it as an example. I'm speaking hypothetically, okay? You can trade in the afternoon. You can trade the London session. I just don't think that you should be trying to trade the Asian session because there's not enough movement in there for me to feel confident to say, hey, look, spend your time and hope to be fruitful in that little bit of market action. It's not. Now, sometimes if there's a news driver that's coming out maybe in Asia, like an Asian market, like the Japanese yen, the Kiwi, the Australian dollar, because their markets are coming online. But the financial day doesn't really technically begin in Wellington. Okay, that's a misnomer. Sorry, Steve, you don't know what the fuck you're talking about. But the idea of this new day starting is New York midnight. That's where it all starts. That's where it starts. And technically, London is a carryover on the next day, where people will say, London is the real start of the day. It's not. It's just a carryover of what took place on the previous New York session. That's what these algorithms look at. That's how they refer to it. That's a real mechanism for referring to day-to-day transactions. But you're hearing things, and you see people in the industry that have titles They come out there and they talk on CNBC, and because they're on TV, because they're wearing a suit and tie, because they have a title underneath their name and they work for some institution, when they say something, it's believed. But many times the shit that they say doesn't even happen. So I'm challenging you to think about things differently. And if you have a bias that you think the dollar is going to go higher, that means that your currency or currencies no more than two. What? Yeah, you're doing too many markets. You're diluting your attention because you think the more opportunities of finding a setup in more markets, because I did the same thing when I was 20 years old. I can't miss it if I'm looking at all these currencies. I got to have 28 pairs because I know eventually I'm going to find something in the chart. That's somebody that's just looking for any excuse to do something instead of knowing how to trade, waiting for the proper setup in a market that is going to. If you look at the euro dollar and the pound dollar, they're closely correlated instruments. Those pairs, those currencies are closely correlated. That means they usually, not always, but they usually move in tandem. They move the same direction usually. Not all the time, but most of the time. And that's advantageous. And it's usually diametrically opposed from what you see the dollar index do. Now, that's obviously market theory 101. Everybody should know that, but a lot of people don't when they first come. But if you filtered out the idea that you think dollar's higher or bullish and you want it to go higher, you're anticipating sell signals in euro dollar and you're anticipating sell signals in pound dollar. And then you can look at the relationships to short-term highs between the euro and pound. And when one of them fail to make a higher high, when the other will, that's an SMT divergence. So right away, what I've done is I've shown you how to think about things logically from a higher time frame, derive a bias where you're only going to operate with the premise that the dollar is going to go higher. And that means euro dollar and pound dollar are your tradable instruments. But you're not just simply using one and saying, I'm going to just focus on euro. That's foolish. You need to look at something that's closely correlated because you'll see a crack in that correlation when the euro and pound dollar. Let's go into euro dollar real quick. I always use forex.com. Not that that's a broker that you should use, but that's the data feed I always use. I've been using it ever since I started teaching it. And let's see. Let's drop into a 15-minute time frame on euro. Oh my goodness, he's talking about forex. I know, I can hear your joy. He's been boring me with these index futures. All right, so if, like I said, the dollar, if it's bullish, if we think it's going to go higher, then our focus and our premise for executions on euro dollar and pound dollar would be on the basis of selling short, looking for reasons to anticipate the market going lower. Okay, so when you're looking at euro, all of this is applicable to index futures too. So it's not like it's something different, because if we're looking at S&P, notice that I'm always looking at what? I'm looking at least S&P and NASDAQ. I'm comparatively studying the relationships of its individual candlesticks delivery, its relative highs, its relative lows. How is it behaving? Is it moving in tandem, or is there a decoupling? A decoupling is when the market simply is not moving in a symmetrical manner where all assets are dropping as they should or moving up as they should. But there is an advantage in knowing and watching closely correlated markets or instruments, because it'll give you a telltale sign, like tipping its hand to you, saying, hey, pay attention to this, because this is a false move. And how do you know it's a false move? Because one of them are not moving to that higher high on a lower time frame. I'll kind of show you in a second, but give me a minute here to lay down some tent stakes here, because I want you to understand what I'm saying. And that way, when you hear me talk about, or you hear me or read me tweeting something to the effect that you have to have a setup that you cannot frame that would be opposing your weekly expectation. Said another way is, if you're bearish on the market that you're trying to trade, and the dollar index is bullish, that in itself is the first ingredient, if you will, of a symmetrical market. That must be there. They must be diametrically opposed. If you can't see the marketplace through that lens initially, you are not in the first stage of high probability. That's just the way it is. I don't care who wrote books and made courses or whatnot. That's just the way it is. That in itself is not the entirety of your model. That's not how all of your trading should be based on. It just means that that's the first stage. Now, if it's not like that, if it's not diametrically opposed, does that mean you can't take any trades? No. It just means that you're probably best suited doing scalps intraday. And if it doesn't fit your appetite for trading, you simply have to sit on your hands and wait for the marketplace to present the opportunities where the dollar index is likely to move one direction, opposed to what you would expect in analysis in your euro dollar, pound dollar, whatever currency that has the dollar in its name as the secondary. If we have the expectation that the currencies or the currency that you're trying to trade is bearish, you do not want to be able to look at that and see something that would be bullish. If you can frame the idea that, yeah, I could see a buy signal, I could take a buy on that because of this, not impulsively, not because your elbow hurt the last time the euro dollar went up, so therefore now it's hurting today, you're going to try to buy it. That's nonsense. There has to be some kind of argument that can be framed logically as to why the market should go higher or lower. If you can be outlined through the mechanisms that you use for trading, if you can see both sides of the expression in terms of buying or selling short in the instrument that you like to track, you're not in high probability. So there's two ingredients right there for high probability trading. If you're an index trader and you think that obviously that we are in a risk off scenario, that means dollars higher, we have to anticipate the likelihood that rallies in indices are suspect. That means that they're not technically sound. They're going up there for a reason. What are they going up there for? To reprice to an inefficiency, or it's going up there to run buy stops. They're the only two reasons why markets go up. That's it. That's all there is, folks. There's nothing else going on. There's no animal patterns behind it. Wyckoff is not there. Supply and demand is not there. It's going up there to engage new sentiment, drag them in by their hair, or disrupt the present sentiment in the marketplace. And it's all based on liquidity, either creating the liquidity or removing it and unseating those individuals that are in the market and then taking their position over, so that way the market can then reprice for them, not you. It's rigged. And you can be mad about that. You can be scared about that and think, nobody can ever beat this. Nobody ever can, be consistent with it. And that's rubbish, because you see my students all over the world now doing it. It's transferable knowledge. And the things that I'm teaching, people are seeing it and they can see it repeat over and over again. And as long as there's a marketplace, as long as trading is accessible to us, it will not ever stop working. So don't worry about it. If we can't trade and then they cut the markets away from us and say, no, you can't trade this. Now, I can't imagine what starts that. But, in the event that it ever happened, whether it be temporary or, something else on a longer term basis, that would be the only thing that would cause me to say, okay, it's done. There's nothing we can do now. So it takes a Mad Max scenario for something like that, I believe. So I don't consider all that much or worry about it. But in the beginning, because you find this and you get excited about how the opportunities are presented to you, and you see them in your own chart and you're thinking, wow, I could do this. I can put my own money in here and eventually grow it to this, or I can get a funded account and grow it to that, and I can make my ends meet. And all of a sudden you start thinking about what if it stops working? Well, what if it doesn't stop working? And all the time your energy you're wasting thinking about all that stuff is being drained. So you don't want setups that you can frame on both sides of the marketplace. So if you're bearish, it should be next to impossible for you to see any reason for it to go higher. No justification for it to go higher. No justification for it to pause. And when you trade in those conditions, that is a low resistance liquidity run. That means the market will move like a hot knife through butter. Just smooth, buttery. That is exactly what you want in your trades. You don't want to be in a trade that when you get in it, it's just spending a lot of time just hanging around your entry. If you look at the executions I share, they're like dynamic. Like when that execution's done, it spends very little time around where I entered and rarely ever moves towards my stop. Now, you've seen me. I've been stopped out and I went back in, did what I wanted to do, and re-engaged it. I executed that. It was live accounts, real money, and people tend to believe that those things don't exist here on this channel or on my Twitter. Like, I'm trading with real money, folks. I've taught for a long, long time in demo, but I'm about to depart from all of you in November on the 11th. And I promised you that you would see real money executions, and you're seeing it. The idea of you getting to the point of trading with real money, it's going to require you to do a lot of things that are in the beginning or feel very boring. But that's exactly what you want it to be. You want it to be boring. Your job pays you your wage when you go there and you do the job. You want your trading to be the same way. You don't want it to be an elevated and emotional, psychedelic event where you're tripping out on goofballs because you're either making a lot of money and you didn't expect it to move that way, or you're losing a lot of money. 8:30. It's the news embargo lifting, so then you can see the displacement here lower. Let's go into a 1 minute chart. So if you can't see reasons for it to go against your weekly bias, if you want it to see lower prices, or if you're bullish, okay, you want to see it go higher, you don't want to see anything that would be argumentative or reasons for you to doubt the setup. And because you're most of the time as a brand new trader or undisciplined, you don't have the ability to sit still and demand that the market creates and presents those opportunities where it's so one-sided. It's so one-sided that you cannot not see it doing what you expect it to do. Versus as a brand new student or someone that just maybe watches my video for the first time and they think, oh, I got this. This is a fair value gap. I'm just going to go out there and find the very first fair value gap that I see on the chart and just indiscriminately go out there and just trade that. Not knowing what to anticipate, what to see, what to think of the market if it does something that would be contrary to what you expect to do. Is it the right time of the day to trade? Just because you sit down in front of the charts doesn't mean it's the right time. The fair value gap, it needs to be engaged at the time of the day, even if it's been traded to before. That's real important. I'll say it again. A fair value gap doesn't need to be the first visit. It doesn't have to be a virgin level, or to use borrow a term from supply and demand because I don't subscribe to that bullshit. A fresh fair value gap. Okay, that is not something that is a thing. It doesn't matter because the algorithm, when it sees inefficiencies, it'll revisit them again. I've taught this. That's why I've mentioned many times when people say I'm regurgitating or teaching what Chris Laurie taught. I've made Chris Laurie come out on public on Twitter and say no, it's not his stuff. So I get it, the team mentality thing, that you want to be able to say that this stuff can't be revolutionary. It can't be something new and trailblazing, but it has been. But it takes a lot of time to learn it. And unfortunately, when you first start, you're impatient, like I was. When I was 20, I was very impatient. I wanted things to happen real fast for me because I didn't like where I was financially. I wanted to make changes, significant changes, like real quick. And I had long-term goals that I was willing to subscribe to, which was if I can make $1,000 a month, I could retire at 40 years old. So I had a 20-year plan. Contrast that with what you're thinking about trading. When you go to these IML bullshit things where they try to teach you how to get rich overnight, Lambo lifestyle. It doesn't compute. It sets you up for failure because the only way you're going to anticipate success is if it happens to you fast. And if it takes a little bit more effort, you feel defeated. You feel like you're being held back. And then that emotional stimuli that you're creating within yourself, because you've been sold the idea falsely fraudulently that it should happen very quickly and easily because you went and you watched some videos, or you went to some kind of workshop, or you bought a software program that's supposed to tell you enigmatic entry points that fucking cause maximum drawdown by the user that created it on live streams every time they try to do it. All these things are going to be barriers for you in the beginning. And I try to be as practical as an educator as I can, and I don't sugarcoat it. I could come out here and say, everything I'm teaching is this, and never tell you the adversities it's going to cause you. But I tell you those adversities, but you put your fingers in your ears and you say, I talk too much. But you need to know those things, because if you don't know what they are, you won't know how to deal with them when you're by yourself with your phone at work, during your smoke break, or in the bathroom trying to put on a scalp, trying to make a little bit of money to get yourself through the day, a little emotional, psychological bump to feel good about yourself because you hate your job. I've been there before. I know what that feels like. I know exactly what that feels like. But there's a wrong and a right way to do it. And I try very hard to try to communicate the things that you're probably going to make the errors in doing. So that way your mind is prepared to seize that moment and say, no, 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 that's the thing that ICT said. I'm probably going to make an error doing that or thinking this way. And it's going to lead to adverse results, results that you don't want. You want to see things objectively, and you want to see them in a balanced manner where you're not impulsively forcing your will on the marketplace. You have to be willing to accept the fact that you're probably going to do it wrong. In the beginning, you're going to do it wrong a lot. And those are opportunities not to shy away from or pretend they didn't exist. They're opportunities to shine a light on the very things that you need more work on. And you're trying to rush through because you either see me, other students of mine, other people that do things that may not even be true. It may not even be real money. They may not have even done those things. People take my videos, if I forget to put a watermark on it, they're out there selling this stuff on Instagram like they did the trade. You have to be guarded. And that's why I tell everybody, don't take my word for anything. If I tell you something, go into the charts and see if it's there. That's why I do everything I do on Twitter. It's time and date stamped. When I point to something, it's there. Everybody sees it. If it doesn't, everybody's seen it. But you have to be willing to accept the fact in the beginning that you have to grow in your understanding. You have to understand that there's going to be things that are going to feel like it should be easy for you to figure out and learn real quickly. But then once you start looking at these candles and it's real time, live, and you don't know what's going to happen over here in this empty space on the right hand side, it becomes scary. That uncertainty becomes paralyzing, and you're afraid to do something because you haven't spent enough time looking at all the stuff over here that tends to repeat at a specific time of day in a specific characteristic and manner of delivery. These things repeat over and over and over again. There's subtle little differences, but overall, they can be recognized. And that time of recognition is going to be dependent on how much time you spend studying old moves and capturing them and journaling them and filling in the empty spaces around it with annotations and observations that you're making. And it's okay to put in questions in here in the beginning, like, I want to focus on why this tends to happen in the marketplace. I see it happening and I want to learn more. Not, I don't know what's going on. This is always confusing. That's self-defeating. It causes and sows chaotic doubt. You don't want that in your journal. You want your journal to be this biggest cheerleading session. The biggest fan of your work is writing that journal. And you're feeding that mental candy, if you will, to encourage your future self. Because this is hard, folks. This is very, very hard. And if you let it beat you down because you don't have a plan, you don't have a strategy, you don't have a study routine, you don't have a model to work with, a framework, a structure to which you go in and you look at it, of course you're going to get frustrated. Of course you're going to feel like it doesn't work for you. Of course it's going to feel like you aren't keeping up with the rest of us. But every single one of my students that are almost millionaires now, and I'm saying that with an M, millionaires, not with demo, they all got there by doing the things I'm telling them to do and avoiding the things I tell them not to do, and limiting what they take from my repertoire. There's an arsenal of things and tools that I've taught. And I've given you a language to look at the marketplace and say, okay, this is what I see in price. I like this fluctuation between this point and that point. It tends to happen at this time of day in this particular market that I like trading. I have an affinity for this setup. That is your model. Don't chase anything new that I put out. I don't care how much money I make with it with a live account. I don't care how much money my son makes. I don't care how much anything that anybody else does with my stuff. That is not something that you should do. That is a trap. It's a trap. All it's doing, like a child, I saw a video actually. It was really interesting. This little boy was sitting at a desk, okay, and an adult put down a stack of money. I don't know the denomination, how much it was, but it was, it obviously if it was placed in front of you, you'd snatch it up real quick. And then they put like a piece of candy or two or something like, or a cookie. That's what it was. It was a cookie, 2 cookies or something like that. And then there was money piled, right next to the little boy. And they said, "Which one do you want?" He went right to the cookie. Oh, that's what you're doing. That's what you're doing. You're rushing to get that sugar high, that junk food idea of getting in on something you barely know how to do because you want to get the feel good moment. And you're avoiding the logic that lets you pick up the money that's laying right there every single day. Every single day, these markets are laying out the opportunity for you to make your ends meet. But you're looking for that sugar rush of getting in there and doing something because you want to be able to either gloat on social media or tell your spouse, look, it's not me wasting my time. Look, I'm looking at all these charts. I'm listening to this asshole talk about things on the marketplace, on YouTube and Twitter spaces. And it's worth something now because look, I get it, folks. Trust me, I get it. I have a wife that still thinks this is all video games. And you saw this morning where I live. It's a lot of balancing acts that have to be done as a trader. It's not an easy lifestyle. You have to be prepared mentally for it. And your setups need to be in a way where you cannot argue it. If you can see both sides of the equation, being long or going long at the time when you want to be short, that's a trade you should not take. And be comfortable not taking it. What happens if it runs and moves 200 pips for you or 500 handles? And the circuit breakers come on, okay, for the stock index futures. So what? That's one event in your life as a trader. That's one event. I was stuck in the marketplace on September 11, 2001. I was stuck in it. I couldn't get out. And I lost when the market reopened. That should have, in many other people's eyes and mine, it would have been, that's it, I'm never trading again. Because it could do that again. You could live in that fear. And in your lifetime, I'm telling you, in your lifetime, within the next 24 months, we're going to see trading halted. Something's going to happen. Some big event that's going to cause trading to be halted, and it's going to cause you all that are inexperienced to lose your mind. And then when the market does eventually start back up again, you're going to go through years of thinking that might happen again, like it did me and like everybody else that was trading back then. It's disruptive. But you have to have the expectation of you're going to have adversities in this. You're going to be met with real risk. That's why you shouldn't over leverage. That's why you should be using a stop loss. That's why you should have a model. You should be looking at 1 or 2 closely correlated markets at maximum. Do your due diligence and focus and limit your focus to what it is that you're risking money behind, or placing the emphasis on trading in either a demo, a paper trading, or tape reading event, that you're not trying to go in to make the maximum amount of money. If you're studying with the expectation that this is how much money I could have earned and this is the maximum of it, you're doing it wrong. You're going after the cookie instead of picking up the money. You're trying to get all of this emotional and psychological reward from something that can come from, look at the response that my son has had. One contract, one single micro contract, and the boy's made almost $2,000. He hasn't taken any trades yet since the last time I updated y'all, because he's waiting for his payout. So hopefully that'll be resolved today or tomorrow. And it wasn't anything that Top Step did nefariously. It was the fact that the deal company that usually they were, I guess, paying through, there's an issue because one of the funded account companies out there got snagged by the CFTC, and deal got tapped on that, so they didn't want to do business with funded account firms anymore. So the money, I guess, will be paid through a standard wire transfer, or I don't know, but he did the paperwork on it. But look at the results of one contract, doing one setup, trying to get 10 handles or 10 to 15, risking 12 handles. Is that a lot? No. But did you make $2,000 in the last week doing whatever the hell you were trying to do? Have you had 100% strike rate every single day, a winning day that you traded? How about that? What's different? Oh, well, it's because it's ICT's son. Oh, it's ICT. It's ICT. You know, of course it's ICT. Either I'm a fraud and I can't trade, or I'm doing what? Getting lucky. Now it's my son. He's using logic. He failed and floundered doing it his own way. He tried to do it his own way, impulsively. Oh, it's like a video game. It's like a video game, Dad. It's going to be easy for me. Without logic. Trying to trade with 15 contracts on a $150,000 combine. And failed, 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 and failed. Got frustrated, wanted to quit, hated it. Then I gave him simple logic. Go for singles. As soon as you get it, you stop. You don't go back in again. Because the times that he did make money, he didn't find satisfaction in that. He wanted to go back in and get more. Because that sugar rush, that cookie mentality. Boy would be making $3,000, $4,000, $5,000 on a trade that he was over leveraged on. He ran through hell before the devil realized he was there. But he wanted to go back in again and tap dance in front of him. And then wondered why he stuck his pitchfork in his ass. You have to be dialed in. You have to know what you're looking for. You have to know why you're trading. Have realistic targets. When you hit them, stop. Over time, he will gravitate towards becoming a 20 to 25 handle trader. Then eventually he'll be looking for 30 to 50 handles. And then he'll be doing 100 handles. And then he'll be doing far less trading. My intentions is not for him to be trading every single day. My intentions for you as a student is not to trade every single day. And that sounds shocking, doesn't it? What do you mean? How am I going to make money doing that? You can make a lot of money doing 3 trades a month and then enjoying your life. Day trading is not everyday trading. And many of you think that just because the markets are open, it's time for you to sit down, pull the slot machine arm down, and see what happens. And then you find out that you didn't like the outcome. But anyway, I thought I was on Twitter for a second there. I did a Twitter space. I apologize if I bored the socks off of you. But look at the euro here versus the pound. We'll look at that real quick, and I'm going to close this session because I want to get ready for my own trading day here. Here's the pound. Okay. Now, if you look at what this move here has done, I ignore this wick. Where's the bodies to the right of it? Here and here. So these are relative equal lows. I would expect the market to want to eventually at least sweep below this one. I would want to see that. Now, does it mean it happens this morning? Might not. But I would look for a setup that would warrant that type of move. And in how we trade below that low, in other words, it would look like this on my chart. I'm viewing that barrier right there. You can see we came right down to it here and then stopped. To me, I like seeing this because it gives the idea that it builds in retail. Oh, this is support. Look, see, it's doing this. And this is where buy side is up here. So it would not be a terrible thing for me to anticipate price running all the way up here, disrupting the buy stops, because if I want to be short, and I'm not short right now, it'd be wonderful to get a short above here, then ride down below here, here, and then keep on going lower, longer term. But we're on the heels of a Fed day, and it's the morning session. So what do? Sit still. Sit still. But what happens if it runs, Michael? You missed it. You can cuss me out later on, but over the career of your trading, that one event, just like September 11th, was a bad thing for me for several days. I couldn't get out. And when they opened that bitch up, I was down a lot of money. There was no way to get out of it. There was no way to get out. Nobody could get out of their trade. Period. That's a scary feeling. That's risk. That's what these markets could end up doing to you eventually. In the currencies, we will, and this is why I'm not trading Forex, okay? I get questions, why are you talking about futures all the time? Why aren't you trading Forex anymore? There was a depegging between Euro and Swissy years ago. Look at your charts. Many brokerage firms, many institutions actually went bankrupt. We're going to see that again. I don't know where or what currency is going to do it on. It might be multiple ones, but that's where we're at, folks. So if you're in here trying to do these crazy leverage trades, and if you happen to be in a day where that decoupling happens, something's going to happen. All these central bank digital currencies that are coming, all these things, you think crypto is going to save your ass. It's not. We're getting ready to see the biggest wealth transfer in history. And it's going to be so abrupt, so sudden. I don't know when it's coming. I just know we're in that season, and I'm not trying to be in currencies. I'm not trying to be there, folks. You're welcome to do that. If you want to do it, you want to make money doing it, that's wonderful. I wish you luck. God bless you. But I'm sticking to a market I started with, which is commodities. That's futures. They're real markets. Currencies, they're all fiat. So is crypto. It's imaginary. Okay, that's not real money. It's all fake. It's illusionary. It's not really there. It's whatever the perceived value is. A commodity is a real tangible thing. Wheat is a real thing. You can consume it. Gold is a real thing. Oil is a real thing. I'm back in the markets I started with in 1992. So I'm back in the real world, in the real markets. And that's why these markets like index futures trade better than Forex. They're much more precise because they're a gentleman's market. They're not a cowboy reckless rebel that does wild things and brokers can screw you with the spread. So maybe I didn't tell you anything this morning that was useful to you. I would have liked to heard what I said today. If I was a new student, new trader, I would like to know these things and think like this. Expect the market to want to do a run below this low on NASDAQ and dig into this level down here. That's my perspective going forward. I'm going to be trading with that idea going forward as well. Until I talk to you next time, be safe.